So I'm going to be going through the irrationality of Mr. Market on both sort of the positive side, but also sort of on the downside, and then sort of how I took advantage of that. We're going to be covering the 52-week low and the 52-week high and that sort of range and how you can profit off it as an investor. And then also sort of I'll give you a case study of something I've recently done during sort of the tariff fears, whilst everyone's sort of panicking, sort of peak sort of April, call it, and that's a really good case study. So we're just going to go through it now.
Okay, so let's get into it. We're going to be going over NVIDIA now and the 52-week range. So NVIDIA is going to be an example. I'll go through a few others as well. And this is just to really show the volatility of Mr. Market throughout just a 1 year time horizon. And the reason I picked NVIDIA is just because it's the largest company in the world. So it's the most followed business. It's got hundreds of analysts looking at it. So you would have thought that the market would be pretty rational and that there wouldn't be much change in theory anyway over a year. So let's get into it. As you can see, we look at this 1 year chart, you can see that the 52-week range here is almost double. I mean, if you look at the very low now, obviously no one's expecting you to buy the low, sell the very top. But what I'm trying to get at here is that there is a rationality, because my point here is what has changed since April 4th for Nvidia to be worth $90 a share or 86 at the low, for it to then be worth literally double or almost double literally 2-3 months down the road. Not much has really changed in those 2-3 months to warrant this business doubling in valuation. And again, there's hundreds of analysts looking at it. It's the biggest company in the world. You've got millions of people who are aware of this business, so it's certainly by no means obscure, and yet there's still such disparity, and a lot of that comes down to irrationality, whether the market's over optimistic or just too pessimistic as well. I'm going to go through a couple more examples. I mean, this is an extraordinary case where Palantir was sort of hated on. It was called I think it was called the Money Destroyer, or it did very poorly, and if you just see that, I mean, over 5 years it's gone up 20 times, and even just in the last year alone it's gone up 400 times. And to me, is that speculation? It's hard to tell. I mean, people are obviously very excited about AI right now. If you look at the valuation, I mean, certainly a forward P of 210 times earnings. Yes, it's a stellar business that's growing rapidly, and it's the early innings of its profitability. But is that a bit rich for me? Yes, it is. Now, of course, it depends based on everyone. It depends based on what you think its numbers are, etc. But for me, that's quite a rich valuation. And I don't think the business has personally increased in value 400% since the start of this year, or since a year ago. I think what this is, it's driven by a lot of sentiment, and particularly as people start to recognize this is a bigger AI play. Yeah, so we'll go into some more sort of, even if you look at like a more stable company, let's say we'll pick up Visa. Visa's known to be like one of the most stable companies in the world. It's been around for ages. I mean, even the likes of Visa, at the peak, we're looking at what, $370. At the bottom, we're looking at about $270. So that in itself is still, yeah, it's not a double, it's not 100% difference, but it's still a 50% difference year on year, which to me is still a massive change, particularly for like a really stable business. And this to me just highlights that there are irrationality and certain and fears, and greed as well. So what I'm trying to highlight here is that the market can be irrational, and whilst it's not very common, and you could say as a whole, that potentially it is more or less in line, that there's with pretty much every single company, ranging from the biggest ones, most obvious, and even the safest companies, there is always going to be fear and greed there. And that's sort of what my job as an investor is, to take advantage of it, really. I mean, if we look at one more example before finally looking at like a case study that I've actually invested in, if I look at, for example, Google's another big one. If we look at it on a year basis, again, there's been about what, $150 to 210. That's just shy of about 40% swing there. Okay, that one's not as big. But again, it highlights my point. Google as a business hasn't grown 40% since last year, or nor has, I think, it become significantly more valuable since a year ago. If we even look at like the last 5 years for Google, you'll see that there's during this period where 2023, where it significantly bottomed, is sort of when everyone was most worrying about ChatGPT and how it's going to steal their business. But I mean, if you looked at it purely from a rational perspective and had the foresight to do so, you could have said, well, yeah, there is a risk there, and I'm not entirely sure that risk is worth. But you could have always said, well, I know YouTube is going to be worth this much. I know the Play Store is going to be worth this much. I know Waymo's worth something. I know their like Google Drive cloud business is worth something. I know their Google Maps segment is worth something. And their Google business is still going to be around for a while. And just based on that, I think you would have been able to comfortably buy it at an $80 a share valuation, regardless of sort of what happened on the AI front in terms of Google search. And in fact, had Google played their cards right with Waymo, their self-driving taxi network, they're currently like the number one, number two player in the world. They could have, they could actually benefit from AI long term more so than they get harmed from AI. A company I personally looked into is Elf. Now I'm not going to go too much into the details as to sort of why I bought it because that's coming in in the next video. But what I do want to sort of go over is the irrationality and the fear that sort of went on. So just to give you a bit of context, this company is one that I've been eyeing up for a while. It's been a very high quality business. It's grown significantly, growing 20-30%. But to me, as someone that likes to buy great businesses at great price, ideally, 40 to 35, 55 forward earnings was always a bit too rich for me. So I'd been looking at this company for about a year, if not more, and there hadn't really been an opportunity to buy any sort of position at a more reasonable price earnings ratio for me until this opportunity came during the April lows, as you can see here on the screen. April lows basically just meant that what had happened is that everyone was panicking about tariffs. Were tariffs going to impact the business? Yes, 100% they were. 75% of their products are made from China, and their 25% are made from other countries which will be impacted by tariffs. But the main thing that people don't realize here is that yes, that's going to happen, but the entire market's going to feel that effect. So yes, there might be a slowdown for 1 or 2 years, but it will gradually even itself out over the next couple of years. And on top of that, it's still a great business to own because it's grown rapidly, etc. There's a lot of things going on for this business. But for me, long story short, when I saw this business at a forward PE of 18, 15 times earnings for a rapidly grown quality business that's recession proof, I just knew that this was, for me, a great deal. And that's sort of when I started accumulating my shares, about the $55 to $45 range. I think it was more $55 for being honest, but still a great time to buy. I did actually end up taking a leap options contract, which I ended up selling. Long story short, I took a bit of leverage out on that, and looking back, I probably shouldn't have done. I would have just been better off just holding it in stock, quite frankly, for me. But yeah, I ended up selling at about $120 ish. But that's just because again I had leverage there, and it'd gone to a forward P of about price earnings of about 40 times, and again it wasn't as attractive to hold considering I had leverage in that position. But yeah, this really just goes to show you that I mean, like though tariff fears aren't around every single day, there is generally every year or every few years, there's generally something that pops in that's a major concern that the market starts panicking about, and if you can just have the foresight to look beyond that, generally I've found I do quite well during those sort of times. And to be fair, it doesn't have to be like a market event. It could just be that it's in particular to one sector or one company. I mean, Facebook when they had the scandal, Facebook when they were spending loads of money on advertising, uh, sorry, not on advertising, when they were spending loads of money on metaverse and it wasn't really yielding much results. So I didn't agree with it. If you just looked at the merits of the remainder of the platform and how much cash they were generating, you could have bought into a position in 2022 that was at $80, $90 a share that's now worth almost 10 times today. Now, I shot myself in the foot there, didn't buy it, so I'm gonna be honest, I wasn't didn't have enough foresight there to, bit hesitant, suck my thumb really on that one, but that just sort of goes to show you that there are these kind of opportunities that you can take advantage of, particularly when you're aware that it's not something fundamental that's long term going to harm the business. That's what I've always found works for me. And that's what I mean about the Mr. Market's irrationality. Like I say though, if you want a full breakdown on my reasoning as to why I bought and sold Elf Beauty, I did sort of cover it briefly here, only on the surface. Then check out next video.